Hi, it's Bob Oupsher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder and CEO of Advisor Perspectives. Nasdaq Dorsey Wright is a recognized global leader in momentum investing. Advisors rely on its flagship relative strength system that powers the investment decisions for $11 billion in assets. Dorsey Wright and Nasdaq are one of the largest smart beta providers with over 450 billion tracking their indices. The ProShares Nasdaq-100 Dorsey Wright Momentum ETF, symbol QQQA, which is the topic for the discussion that will follow, seeks investment results before fees and expenses that track the performance of the Nasdaq-100 Dorsey Wright Momentum Index. My guests are Simeon Hyman of ProShares and Jay Gragnani of Nasdaq Dorsey Wright. Simeon joined ProShares in 2013 as its head of investment strategy. He leads ProShares' team of investment professionals engaged in portfolio analysis, product research and development, education, and the delivery of investment strategies using the company's ETFs. Jay is the head of research and client engagement at Nasdaq Dorsey Wright. So, Jay and Simeon, before we get into the details of relative strength and momentum, tell me a little bit about your career path and what led you to the roles that you have today, as well as what those roles encompass. Simeon, let's start with you.
Sure. Thanks very much for having me today. Appreciate everybody's time. And look, I've been rattling around this side of the world for over 20 years now. Before I got the ProShares, I was on the wealth management side. I was chief investment officer of the Lehman Trust Company, ran asset allocation and manager due diligence at UBS. And then for fun, I was building the robo-advisor at Bloomberg. So anybody who wants to reach out and talk about the final days of Lehman that were not covered in the movie, please feel free to reach out. I've been at ProShares for almost 8 years now, and it just was a perfect fit. I really wanted to be part of a 21st century solution offering asset management solutions to help people accomplish their clients' goals.
Well, I'm going to ask you a little bit about ProShares in a second, but first, Jay, tell me about what led you to where you are now.
Sure. Thank you, Bob. Appreciate you having us on, and thank you all for taking the time to listen to us. So, my career path thus far has been relatively simple. I started with Dorsey Wright and Associates, now Nasdaq Dorsey Wright, back in 2005, and started as an intern when I was finishing up at Virginia Commonwealth University. And so, when I joined, I started working for Tom Dorsey and the team, like I said, as an intern. Then joined full time upon graduation. And here we are, roughly 15, going on 16 years later, and having been part of a phenomenal organization, now being part of the broader NASDAQ family for the better part of the past 6 years since being acquired by NASDAQ about a little over 6 years ago now. And, a big part of what it is that I do is help provide research tools and analytics to help support financial advisors in their businesses, whether it be through research that we provide through our research platform, or whether it's working with many of our partners out there to build and develop investment strategies for our collective clients out in the marketplace. So great opportunity to be here, and I appreciate the time.
Great. And Tom Dorsey certainly is a legend in the world of investing. Simeon, back to you. I know ProShares has been around for 15 years. You've been there for a little more than half of that time. How is ProShares positioned now in the ETF industry?
Look, it's important for us to be offering differentiated solutions, and that's really our objective at ProShares. Many folks may know us from the inception of the ETF business for us as the folks with the leverage and inverse ETFs, which are a really unique and important tool for folks to put together in portfolio construction, in risk management, etc. We have, over the last 10 years, also launched a full array of what you might just call meat and potato center the plate strategies, like dividend growth and interest rate hedge bond strategies. So that is an important growing part of the business. But the calling card of all of them is a differentiated solution.
NASDAQ and Dorsey Wright specifically is known for its innovation in stock selection. Jay, tell me a little bit more about the technical analysis and trading systems that you've developed and how they are positioned to help financial advisors.
So, Dorsey Wright as a firm was founded back in 1987 by Tom Dorsey and Watson Wright back in the day, who you mentioned earlier. And prior to the inception of Dorsey Wright, Tom and Watson were utilizing technical analysis and very specifically point and figure technical analysis to develop option strategies as they ran an option strategy department for a regional broker dealer firm. And so while we were founded in 1987, the use of technical analysis, and again, very specifically, point and figure technical analysis, goes back well over the history, even just the history of Dorsey Wright. But the point and figure methodology dates back even further than that, back to the late 1800s, and Charles Dow being the big proponent of point and figure methodology back in the time. What we have done with that over the years is evolve the use and application of point and figure technical analysis to build a comprehensive suite of research tools and analytics to help empower financial advisors to build portfolios and ultimately implement those solutions into the marketplace today. And so when we think about the point and figure methodology, it's really, nothing more than a logical, organized way of uncovering the imbalances between supply and demand in the marketplace. And because it's based on price, it is very much based on an objective input into the market, that being the price of each individual security being compared to every other security in the marketplace. And so it's that basic economic concept that is where everything centered around, whether it be a subscription based service that we provide research through, whether it be a number of indexes or actively managed strategies that we have in the marketplace. It's very much about this simple economic concept. And it goes back to Econ 101, right? If there's more buyers out there for a particular good than there are sellers, then prices have to rise. If there's more sellers out there for a particular good than there are buyers, then prices have to fall. And if buying and selling pressure are equal, then prices have to remain the same. Well, it doesn't matter if we're talking about baseball bats or sports cars or steak and potatoes or stocks on Wall Street. Those same basic economic concepts apply. And what the point and figure methodology is designed to do is help identify which areas of the market, stocks, sectors, asset classes, are being controlled by demand and moving higher in price. And then ultimately, and perhaps more importantly, identifying which areas of the market are being controlled by supply and moving lower in price. Obviously, as an investor, we want to be on the right side of those big trends more often than not. And that's where something like an objective point and figure methodology overlay can help add value or potentially value to the investment process over time.
My first job when I graduated from business school was with a company called Technical Data. And we were very much into the world of point and figure charts. So I had an early indoctrination into that field. Tell me about relative strength, Jay. How does that work?
So relative strength really to us is nothing more than a means of identifying leadership. And very, specifically what we're doing is we're comparing individual securities to one another, where we might compare an individual security to a broad market benchmark to understand if that stock is doing better than just the broad equity market. But then we can take that a step further and say, how are these stocks, maybe a universe of stocks, how are all of these stocks doing relative to each other? So we can very much identify which stocks are outperforming and which stocks are underperforming. Mechanically, there's a very simple calculation that we go through. We take the price of a stock, we divide it by an index, we multiply that number by 100, and then we plot that reading onto a point and figure chart. And so for us, it's not necessarily that reading that is the most important piece, but it's how that point and figure relative strength chart reacts to those daily readings that we're putting in there. And so if we think about that for a minute, just the idea of relative strength, again, a means of identifying leadership. If we think about that in other aspects of our life, and one of the things that I think a lot of us can coalesce behind and rally behind the idea of relative strength as it relates to sports, no matter what sport it might be, football, baseball, basketball, golf, cricket, whatever it might be. If we think about your favorite sports team, I'll talk about baseball right now because we're in the thick of baseball season. How does a baseball team make it to the playoffs? Well, the way that a team makes it to the playoffs is by winning games. It doesn't necessarily matter if they've got the first round draft pick on their team, or the Cy Young Award winner from last year, or the National League Manager of the Year. If all of those things are in place, but they're not winning games, they're ultimately not going to make it to the playoffs and then ultimately move forward. Relative strength is just simply identifying the number of games that those teams are winning. They're not taking into account all of the other fundamental data points that might exist, but it's very much looking at the result of those games every single day. Well, that's exactly what we're doing with relative strength. We're looking at what those stocks are doing relative to each other every single day, regardless of who the CEO of the company might be, regardless of how strong their balance sheets might be, regardless of all of those informations. We very much believe, and like you were mentioning earlier in technical analysis, we very much believe that all of that relevant information is ultimately flowing through the price of that security, and that price of that security is going to then come out the other side and give us a sense of if those stocks are likely to continue to outperform. And what we have found, based on a lot of studies that we've done, based on a lot of other academic work that's out there, is those stocks that have shown the best performance on the quote unquote field, or best performance in the market. Those are very often the ones that are likely to show the best performance on a go forward basis. And in other words, investing in those companies that are the stocks of the companies that have strong momentum, strong price momentum, is something that we have found that over time has shown the ability to outperform just the broad-based benchmark. So your simple question of what is relative strength, the simple answer is, very much it is a means for us to identify leadership trends in the market. Not only leadership trends in terms of which stocks are likely to outperform the market and identifying those, but also understanding and identifying which stocks are no longer showing strong relative strength and are likely to underperform the market. Those are the ones that we want to very systematically remove and get out of the portfolios, or get out of the indexes that we're looking at.
So I want to understand how the identification of those leading stocks and of those lagging stocks translates into ETF construction. Simeon, you and ProShares have partnered with Nasdaq Dorsey Wright. You've introduced this new fund, the ProShares Nasdaq-100 Dorsey Wright Momentum ETF. As I mentioned, the ticker is QQQA. Tell me about that fund.
We're really excited about this one. It's almost a no-brainer, the opportunity. We like first, we like onlys, we like to be differentiated. And indeed, QQQA, which tracks the Nasdaq-100 Dorsey Wright Momentum Index, it is the only ETF that provides investors access to a momentum-based strategy on the Nasdaq-100. I mean, when you put these together, you've got the Nasdaq-100 that is it's the bellwether for innovative companies, and the performance over the last several decades, just on a standalone basis, is at the top of the charts. And to be able to combine that with momentum, number one, which is one of the most studied academic factors, with a great deal of persistent outperformance over the many decades of it being studied in academia, but to be able to do that with the well-known practical approach of relative strength from Dorsey Wright, that was just a combination that we certainly couldn't pass up, and are excited to bring it to the marketplace. More formally, it's 21 stocks. So these are the top stocks that are identified by the relative strength approach, and they are equally weighted, and that's what constitutes the index, and QQQA is an ETF.
Jay, how do you choose those 21 stocks?
So very simply, we put them through our relative strength ranking. We take those 100 names that are in the NASDAQ 100, and we rank those stocks 1 through 100. And so very simply, what we're doing behind the scenes is each stock is being compared to every other stock out there. And what that means is there's almost 10,000 relative strength charts that are being calculated in order to come up with these rankings that we can objectively rank 1 down to 100. And the goal of the index is to identify 21 stocks. 21 stocks go into that index, and then those rankings get reviewed once a quarter. So once a quarter, we're going to go in and see if those 21 stocks, if they're continuing to show good relative strength, they're going to stay in the index. If those stocks that are in there, if they fall sufficiently out of the rankings, out of the top half of the rankings, essentially, then those stocks are going to get sold and replaced with higher ranking stocks that are not currently in there. And then again, that's going to be done on a quarterly basis. So it's very much systematic, very much rules based. Again, the goal is to own 21 out of the 100 stocks that are in the Nasdaq-100 that are showing strong relative strength characteristics versus the others in the universe.
Simeon, what else can you tell me about the way that the index is constructed, and particularly why you think what gives it an advantage?
Sure. I want to go back and highlight the equal weighting. Equal weighting from sort of a portfolio construction standpoint comes specifically from the notion that the signal, this relative strength index, relative strength score, has sort of the same power, predictive power for each name. So therefore, you would equally weight. It was as if you were an old school stock picker and you had equal conviction across your names, you would equally weight. But in this environment in particular, there is an added advantage because we all know that just about every broad benchmark out there, whether it's the Nasdaq-100, the S&P 500, whether it's the tech sector, there is top heaviness and concentration risk, and that is just another nice benefit, particularly in this environment, the equal weight approach, that it gets rid of a little bit of that concentration risk that we know that is lurking out there, particularly after the strong run of some of the very specific sectors that we've seen over the last couple of years.
How can this momentum strategy be paired with the Nasdaq-100 to offer investors even better positioning?
Sure, and I'll mention, I guess, reiterate something that Simeon had said earlier. Is it is the very first index to provide momentum overlay to the Nasdaq-100. So what this index, what the strategy is designed to offer investors is really access to 21 of the strongest relative strength names out of an inventory of the Nasdaq-100, which is among the most innovative companies in the world. And the fact that it is something that is very systematic and rules based and based in momentum, by definition and by nature, it has this built in process of being able to, within an index construction, being able to let the winners within the index run while also systematically cutting those losers out of the portfolio. In other words, as long as those stocks that are in there continue to show positive relative strength and continue to show outperformance, those stocks remain in the index. But at the same time, without emotion in the equation, if they underperform, if they fall to our sell thresholds, then those stocks are going to very much get systematically removed from the index at the quarterly evaluation process. So, those things combined, I think, bring a pretty unique offering potentially to investors in accessing 21 of the strongest relative strength names within an inventory of some of the most innovative companies in the world. But also, and I don't think this point is taken lightly, as we have been running momentum indexes for a number of years, but also not only those 21 names, we talk a lot about that, but it's about those names that we need to get out of the portfolio, get out of the index. Very oftentimes it's very easy for investors to let their losers run and not have a sell discipline and threshold in place. And that's what a systematic nature of an index like this can bring, is the rules that will force a stock to be removed from the portfolio if it falls to a certain threshold.
If I looked at the list of the 21 stocks that are in there now, are there any names that might jump out as immediately recognizable to me or to our listeners?
There would be one or two, and a few I would say for sure. I mean, what's interesting though, at the last recent rebalance, I mean, right now you see a couple names that are among the more well-known Nasdaq-100 names like Alphabet and Tesla, but there's some also interesting names in there as well that might not have been thought about as being a part of the index. Some of those names in some of the other sectors that we're looking at that are not technology specifically named. It's not stocks that are within the technology names. And as a matter of fact, there's very few, only one, what would be considered a FANG name in the portfolio at this point in time. One interesting stock that we probably all heard of, though, that is in the index is a stock that would be in the subgroup of leisure, but Marriott is an interesting name that we've seen show up within there, and again, not a name that we would necessarily think synonymously with the Nasdaq 100, but it is one of those names that is showing a strong relative strength picture right now.
Simeon, where do you see the allocations coming from when someone makes an allocation to QQQA? What are your thoughts on that?
There are folks out there that run a factor rotation or factor satellites around the core equity position. And so this is a momentum strategy. That is a natural fit. But what we also see is that there is a real nice and clean way to deploy QQQA in a core equity allocation. And what do I mean by that? There has been a lot of press lately about how momentum strategies, when they are applied to the very broad market, they're changing their stripes dramatically. You have what might look like growth stocks for a couple of quarters, and then you might have something that looks like a value fund a couple of quarters later. That may be appropriate for some folks, but it is a challenge for portfolio construction. Here, we think there's a great balance. Jay made the case of the Nasdaq 100 being broad enough to bring out the best opportunities that relative strength has to offer, but it's still the Nasdaq 100. You're always going to have large cap growth, and that makes it a really nice fit in the large cap growth sleeve of your core portfolio. And we think that makes portfolio construction kind of friendly and clean in this instance. So those are the two ways we see people deploying it: as a momentum factor satellite, but very appropriately as a large cap core growth allocation.
So for my final question, I'm going to ask each of you to chime in on, and it's this: if there's one key takeaway that you would like to leave our listeners with when it comes to how to evaluate the type of technical analysis and momentum strategy that you've developed, what would that be? And Jay, I'll start with you.
So there's a couple takeaways that I think I would put out there in terms of just being around technical analysis and momentum strategies for a number of years. One of those would be, what we have seen work so well over the years is momentum strategies lending themselves very much to the ability to letting winners run and cutting losers off. And that is so important. And I think that is something that is so difficult to do when managing a bunch of individual equities, but very rules based to do inside of an index type of this, of letting the winners run and cutting those losers out of the portfolio when they need to. And for us, I think that is one of the big takeaways from building and constructing indexes and portfolios is, consistently trying to push the portfolio, whatever that portfolio might be, whether it's an index like we're talking about here, whatever it might be, but consistently trying to push the portfolio towards the leadership trends in the market and consistently removing those laggard areas from the portfolio. Because what we know is that the majority of trades might not work out. You might have a lot, if you go back and there might not be a whole lot of quote unquote winning trades. But very often what we find is a bulk of the excess return in portfolios can come from a very small number of trades that are showing the ability to just win, and letting those winners run oftentimes is one of the biggest things that we've seen work well.
Simeon, for you?
I am going to keep this even simpler. I've been doing the rounds with Jay now for a few weeks now since our launch. And the message I've heard him say, even more compact: just remember that momentum and relative strength don't just tell you what to buy, they tell you what not to buy.
All right. Well, thank you for that succinct answer. And we'll include a link to the fact sheet for the QQQA ETF and the notes that accompany this podcast. We'll also include a link for more information on both ProShares and Nasdaq. Dorsey Wright, Simeon, and Jay, is there anything else you'd like to add?
I'm good for the thank you to Advisor Prospectus for the opportunity, and thanks for all who are listening for their time.
Likewise, I will second that, Bob. Thank you. Thank you, Advisor Perspectives, and thank you all for the time. We really appreciate it.
Well, it's my pleasure, and thank you for listening to the Gaining Perspective podcast with Bob Hoopsher. Today featuring Simeon Hyman of ProShares and Jay Gregnani of Nasdaq Dorsey Wright. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.